there, accountants. I hope all is well, and I pray that as you are viewing this video, that you're in the best of health and spirit. This video will cover Chapter 2, Analyzing Transactions from Corporate Financial Accounting, 16th edition. So as we're going to learn, Chapter 2 is the most important chapter in the text. The purpose is to introduce the rules of debit and credit, chart of accounts, 2-column journals, 4-column ledgers, T accounts, journalizing and posting transactions, as well as the trial balance. So it's very imperative that as we go through this chapter, that you understand the foundational accounting principles. So the Chapter 2 objectives are: Objective 1, describe the characteristics of an account and a chart of accounts. Describe and illustrate journalizing transactions using the double entry accounting system. Describe and illustrate the journalizing and posting of transactions to accounts. Prepare an unadjusted trial balance and explain how it can be used to discover errors. 5, describe and illustrate the use of horizontal analysis in evaluating a company's performance and financial condition. So first things first, we live in this day and age where we receive lots of emails. We get emails from friends, relatives, subscribed email lists, even spammers. But how do we organize these messages, right? Maybe you might create folders to sort the messages based on the sender or the topic or the project, or maybe you use keyword searches. You might even use filters or rules to automatically delete any spam messages or have a special folder for specific messages. So in any case, you're basically organizing information so that it's simple to retrieve what you need. And in the same way that a person might organize their email, companies develop an organized method for processing, recording, and summarizing financial transactions. And that is what we will learn as we go through this chapter. So in Chapter 1, we essentially recorded all of the transactions for Net Solutions, recording the accounting equation. But we essentially have to keep in mind, we only did several transactions. Imagine there's companies, Fortune 500 companies that have thousands or even millions of transactions daily. So as a result, there needs to be an accounting system that's designed to show increases and decreases in each accounting equation as a separate record. So this is what we have here. And this record is called an account. So an account in its simplest form has 3 parts. There's a title, which is the name of the accounting equation element that's recorded in the account. There's a space for recording increases in the amount of the element, and there's a space for recording decreases in the amount of the element. So here we see for these accounts, assets, we have cash, supplies, and land. Our liabilities, we have accounts payable. And for our stockholders' equity, we have common stock, which represents shareholder investments, dividends, which represents distributions to shareholders, fees earned, which represents revenue, and our various expenses. So to record transactions, the account form that it follows is called the T account, simply because it represents the letter T. And with the letter T, we basically have what's called the left side of an account, and we have what's called the right side of an account. So oftentimes, as it relates to accounting, there's a lot of confusion when you hear debit or credit. So to clear up any of that confusion, anytime you hear the word debit, I do not want you to think of an increase or a decrease. I simply want you to think of debit as the left side of an account and credit as the right side of the account. So those are the simple definitions for debit. Debit means left and credit means right. So the left side of the account is pointed out as the debit side, and the right side of an account is called the credit side. So the amounts shown in a cash account from Exhibit 1 would be recorded in cash accounts as follows. So recorded transactions in accounts, they have to follow certain rules. So anytime we have increases in assets, they're recorded on the debit left side of an account. And anytime we have decreases in assets, they're recorded on the credit right side of an account. So I want you to think of it as a coin. For a coin, there's 2 sides. You have heads or you have tails. There's no in between. So as it relates in accounting, Each account, whether it's an asset, a liability, or a component of stockholders' equity, each account has a left side, which is the debit, and a right side, which is the credit. And depending on the type of an account, a debit might have an increasing effect or it might have a decreasing effect, vice versa for a credit. The credit might have an increasing effect or it might have a decreasing effect, but it ultimately depends on the type of account. So next we have what's called chart of accounts. But before we even get there, right, if we think of an actual accounting system, there's a more formal account form that replaces the T account. So later on in this chapter, we'll learn about a 4-column account. And the T account, however, is basically a simple way to illustrate the effects of transactions on accounts in the financial statements. And for this very reason, that's essentially why we use the visualization of the T account in order to explain transactions. So next we have this chart of accounts, and a group of accounts for a business entity is called a ledger. So a list of the accounts in the ledger is called the chart of accounts. And these accounts are normally listed in the order in which they appear in the financial statements. The balance sheet accounts are always listed first in the order of assets, liabilities, and stockholders' equity. And the income statement accounts are then listed in the order of revenue and expenses. So assets are defined as resources owned by the entity. So these resources, they can be physical items that we can see, touch, and feel. These are referred to as tangible items. So these can be cash, supplies, equipment, etc. So we have tangible items, those that we can perceive with our 5 senses, and we also have intangibles. So these are things that have value, but we cannot perceive them with our 5 senses. We can't see them, we can't touch them. And a great example of this would be a patent or a trademark. It has value to a company, however, you can't perceive the value, you can't perceive the asset with your 5 senses. So some example of intangible assets is pointed out: patents, trademarks, copyrights. And then some additional assets that aren't necessarily physical items might be accounts receivable. This is in the event that you provide a service to a customer on account and they're going to pay you later. Prepaid expenses. This is if you pay for a bulk of supplies in advance, or if you pay for insurance in advance. Might include buildings, equipment, land, etc. Next, we have liabilities. And liabilities are essentially debts owed to outsiders, such as creditors. And as we'll learn, you might also owe customers. If customers pay you in advance, then you owe services or products to your customers. So liabilities are often identified on the balance sheet by titles that include payable. Some examples of liabilities include accounts payable, notes payable, wages payable. And as previously mentioned, cash received before the services are delivered or the product is sold, that creates a liability to perform the service or to provide the product. So these future service commitments are called unearned revenues. So some examples of unearned revenues might include magazine subscriptions, insurance that's paid in advance, tuition received at the beginning of the term of a college. So you have to keep these things in mind. Liabilities are not just debt owed in the form of money, but sometimes you can owe services. You have an obligation to perform a service or to provide a product. Next, we have stockholders' equity. As we learned from chapter 1, stockholders' equity is represented by the balance in common stock, which represents the investments by shareholders in retained earnings, which essentially consists of revenue and expenses, in addition to the dividends, which are distributions made to shareholders out of the retained earnings account. Next, we have revenues. Revenues are increases in assets and stockholders' equity as a result of selling services or products to customers. And when we perform a service, we earn the revenue, and it's either the customer pays us right away, which has an impact on our cash, or they pay us later, which has an impact on our accounts receivable. Next, we have expenses, and expenses result from using up assets or consuming services in the process of generating revenue. Some examples of expenses include wages, rent, utilities, supplies, and miscellaneous expenses. As it relates to expenses, it's either we pay for it right away or we pay for it later. So when we pay for our expenses right away, it has an impact on our cash. In addition, if we pay for it at a later date, we have a payable, an obligation to pay for this expense at a later date. And then we also see it results from using up assets. So if we pay for insurance in advance, let's say we pay for a 6-month policy, and let's just say to make it easy that it is $100 per month, we pay $600 on January 1st. At the end of each month, we record an expense for $100 for insurance expense, and then we reduce the balance in our prepaid insurance. So here we essentially have an example of a chart of accounts for net solutions. So a chart of accounts, it should meet the needs of a company's managers and other users of its financial statements. Sometimes the accounts within the chart of accounts are numbered for use as references. In a numbering system, it's normally used so that new accounts can be added without affecting other accounts. So all businesses use what's called the double entry accounting system. So this system is based on the accounting equation, and it requires that one, every business transaction must be recorded in at least 2 accounts, and 2, that total debits recorded for each transaction must be equal to the total credits recorded. So the double entry accounting system has a specific rules of debit and credit for recording transactions in the account. So as we pointed out, debit simply means left, and credit simply means the right side of an account. So the debit and credit rule for balance sheet accounts are as follows. So on the left side, for our asset accounts in particular, anytime we debit an asset account, this represents an increase. Anytime we credit an asset account, this represents a decrease. So this is different for our liability in stockholder equity accounts. So we see anytime we increase our liability, we will credit that account. Anytime we decrease our liability, it will have a debit. And it's the same for our stockholders' equity. Increases are reflected with a credit, and decreases are reflected with a debit. So the debit and credit rules for our income statement accounts is based on a relationship with stockholders' equity, as we discussed earlier. Revenues increase stockholders' equity, and expenses decrease stockholders' equity. So as it relates to our statement of stockholders' equity account, we know that we have what's called dividends. So the debit and credit rules for recording dividends are based on the effect of dividends on stockholders' equity. So as we know, dividends represent a decrease to stockholders' equity. There is a distribution to shareholders from the retained earnings, so therefore it has a decreasing effect. So therefore, anytime we are dealing with the dividend account, there's a debit for increases and there's a credit for decreases. So this is just an example of the rules of debits and credits and what's called the normal balances of accounts. So as it relates to the normal balances, what that simply means is the side on which an increase is shown. So here we have our balance sheet accounts. We have assets, and as we know, it's increased on the left side, the debit, and decrease on the credit side. We have our liabilities where things are reversed. So for our liabilities, it's increased with the credit, decreased with the debit. And then we have our common stock, which is increased with a credit and decreased with a debit. And then our dividends, which is increased with a debit, decreased with a credit. And then our retained earnings, which essentially has an impact on our revenue and expenses. So it follows the same logic. Credits increase our retained earnings. So anytime we earn revenue, it is credited. And our debits decrease our retained earnings. Hence, anytime we incur expenses, our expense accounts are debited for increases. So the next step after we record these transactions, we have what's called journalizing. So using the rules of debits and credits, transactions are initially entered into a record called a journal. So the journal serves as a record of when the transactions occurred and were recorded. So using the rules of debits and credits, again, initially entered to a record called a journal, and lets you know when the transactions occurred and were recorded. So here we have this example. It says Chris Clark deposited $25,000 in a bank account in the name of Net Solutions in exchange for common stock. So the first thing we need to do is analyze the transaction. What is happening? What is taking place? So in such case, we see that money is coming into the business, and as mentioned from chapter 1, money is coming into the business because we either borrowed money, the owners invested money, or the business earned money by providing a service or selling a product. So in this case, we know that cash is an asset account, and anytime we need to show an increase in our asset account, we need to debit the account. So we start off with our first step, the date, which is November 1st. The second step is determining which account is going to be debited. And in this case, it's our cash account. It's an asset account. So there's an increase. The next step is we determine the credit. So as mentioned, there's 3 reasons in which cash would come into this business. In this case, there was an investment by the owner. So we credit our common stock account because it shows an increase. So we debit cash, credit our common stock account. And then from there, we essentially record a description. So we enter a brief description to let us know, okay, issued common stock for cash. And then the last step is step 5. This is called a posting reference. This is generally left blank when an entry is initially recorded, but as we go on throughout the chapter, we'll learn more about why this post reference is there. So journalizing. The process of recording a transaction in the journal is called journalizing. The entry in the journal is called a journal entry, and the form of the journal illustrated is the 2-column journal. So these are essentially the steps as we just pointed out. Step 1, the date of the transaction. Step 2, the title of the account that's going to be debited. Step 3, the title of the account that is going to be credited. Step 4, we list a brief description. In step 5, the posting reference column. So here we see some transaction terminology and related journal entries. So receive cash for services provided, services that are provided on account. If you receive cash on account, purchased on account, paid cash, issued common stock, paid dividends. So these are some common transaction terminology within accounting. So on November 5th, Net Solutions paid $20,000 for the purchase of land as a future building site. So again, all of these transactions that we are going to refer to, they build upon what we've learned in chapter 1. So Net Solution paid $20,000. We know that there's a decrease to cash anytime we see the word paid. So here we see we paid the $20,000 in cash, but the key thing is that we essentially also have an asset. So in this journal entry, we debit land. After we've recorded the date, November 5th, we debit land for $20,000. There's an increase to our asset account. And then we credit cash. Cash is an asset account, and we want to show a decrease to our cash account. So therefore, we credit the account. The next part of the step is that we essentially need to record it in the respective accounts. So here we see land, we place the amount on the left side, which is the debit, and for cash, we place the amount on the right side, which is the credit. On November 10th, Net Solutions purchased supplies on account for $1,350. In this example, we purchased an asset, but we didn't pay for it right away. We decided to pay for it at a later date. So in such case, we debit our asset account supplies and we credit the liability account because we have an obligation to pay in the future. So November 10th, we debit supplies, our asset account, to show the increase, and we credit our liability account, accounts payable, to show the increase. For transaction D, on November 18th, Net Solutions received cash of $7,500 from customers for services provided. So in this case, we debit cash for the $7,500. There's an increase to our asset, and we credit our stockholders' equity component revenue for $7,500. On November 30th, Net Solutions incurred several expenses. There were wages expense, rent expense, utilities expense, as well as miscellaneous expense. So we paid all of these expenses. And now the key thing is that at the end of the month, as we're recording this transaction, as we know, expenses have a decreasing effect to our shareholders' equity. So therefore, all of our expenses will be debited, and we would credit our cash account because we are paying cash, and there is a decrease to our cash account. For F, November 30th, Net Solutions paid creditors on account. And one key thing to keep in mind, that anytime we see paid, we know that that means that cash is being reduced. So cash will always be credited anytime we see paid. So in this case, we credited cash and we debit our accounts payable account because there is a decrease to our liability. Initially, we owed our vendor $1,350, and now we paid off $950 of that balance. So we debit our liability account to decrease the amount, and we credit our cash account because we have $950 less. November 30th, Net Solutions determined that the cost of supplies on hand, which essentially means how much supplies we have left, is $550. So remember, we started off with $1,350 that we paid for in advance. And at the end of the period, we only have $550 left. So think of it like a bank account. You started off with $1,350 in your account at the beginning of the day. And now at the end of the day, you only have $550 left. And that means that you spent, or you've used up, $800. So in this case, we are talking about supplies. We started off with $1,350 worth of supplies, and now we only have $550 left. So therefore, we've used up $800 worth of supplies. So therefore, our journal entry is to debit supplies because we've used up the assets, we've consumed them, and we credit our prepaid supplies account for $800 to reduce the balance from $1,350 to $550. Here we have H. We paid dividends of $2,000. So in this case, there's a decrease to assets because we're paying cash, and we have dividends, and we know that dividends represents a decrease to stockholders' equity. So therefore, we debit the dividends account for $2,000, and we credit our cash account for $2,000. So as we see, this is essentially expanding upon what we've learned in chapter 1. So as illustrated, a transaction is first recorded in a journal. Periodically, the journal entries are transferred to the accounts in a ledger, and the process of transferring the debits and credits from the journal entries to the actual account is called posting. Although T accounts are useful for illustrating the recording and posting of transactions, there's a more formal multi-column account that's used in practice. And this is a 4-column account. It has the date, the item, the posting reference column, as well as the debit and credit columns for posting transactions. So here we have an example. Net Solutions paid a premium of $2,400 for an insurance policy for availability, theft, and fire. The policy covers a 1-year period. All right, so advance payments are expenses such as for insurance premiums, and these assets are called prepaid expenses. So in this case, they purchase insurance protection for 12 months in advance. So this transaction is recorded as a $2,400 increase, a debit to prepaid insurance, which is an asset account, and a credit to cash because we're paying cash, therefore there's a decrease to our cash account. So as we're posting the journal entry to their accounts, the debits and credits for each journal entry are posted to the accounts in the order in which they occur in the journal. So therefore they are in chronological order. So there's 5 steps. We start off with the date, December 1st. Step 2, the amount that's entered into the debit column of prepaid insurance. Step 3, the journal page number 2 is entered in the posting reference column of prepaid insurance. The account number 15 is entered in the posting reference column in the journal. And the account balance of $2,400 is entered in the balance/debit column of prepaid insurance. So here we see an example of how this unfolds. We start off with the journal entry, debit to prepaid insurance and credit to cash. We list the amount in the specific account itself, prepaid insurance. We have a debit of $2,400, and then we list the balance in the account. And we do the same thing for our cash account. We have this transaction of $2,400. It has a decreasing effect. So we see that as of November 30th, our balance was $5,900. But after we made this payment on December 31st, or on December 1st rather, our cash balance decreases to $3,500. So here we have another transaction. And on December 1st, it says Net Solutions paid rent for December of $800. So the company from which Net Solutions is renting its office space now requires the payment of rent on the 1st of each month, rather than at the end of the month when you've used up the rental space. So the advance payment of rent is an asset, much like we just saw with prepaid insurance, right? But in this case, the advance payment of rent is an asset, much like the advance payment of insurance premium in the preceding transaction. However, unlike the insurance premium, this prepaid rent is going to expire in a month. So when an asset is purchased with the expectation that it's going to be used up in a short period of time, such as a month, in the normal practice, it's normal to debit the expense account initially. The reason being is because this avoids having to transfer the balance from the asset account, prepaid rent, to an expense account at the end of the month. Versus if we paid for 6 months in advance, then it would make sense to set up a prepaid rent expense because we only record expenses in the period in which they occur. But in this case, it's just 1 month, so we just record it as a rent expense at the onset, which avoids us from having to do an additional journal entry at the end of the month. So we would debit our rent expense and credit our cash account for the $800. Next, we have transaction 3. And it states Net Solutions received an offer from a local retailer to rent the land purchased on November 5th. The retailer plans to use the land as a parking lot for its employees and customers. Net Solutions agreed to rent the land to the retailer for 3 months, with the rent payable in advance. Net Solutions received $360 for 3 months' rent beginning December 1st. So here we see that by agreeing to rent the land and accepting the $360, Net Solutions has incurred an obligation to the retailer. So for the month of December, January, and February, Net Solutions has agreed to allow this retailer to use the land as a parking spot. So this obligation is to make the land available for the use of 3 months and not to interfere with its use. The liability created by receiving the cash in advance of providing the services is called unearned revenue. And as we learned, unearned revenue is a form of a liability. So as time passes, the unearned rent liability will decrease and it will become revenue. So thus, this transaction is recorded as a $360 increase to cash. We've received cash money, and there's a $360 increase credit to unearned rent, which is our liability account. Next, on December 4th, Net Solutions purchased office equipment on account from Executive Supply Company for $1,800. And here we have an asset, office equipment, and liability account, accounts payable. So anytime we see on account, that means that there was no exchange of cash. So therefore, there is an obligation to pay in the future. So we debit the office equipment, the asset account, and we credit the accounts payable liability account for the $1,800. Transaction 5, Net Solutions paid $180 for a newspaper advertisement. Anytime we have an expense increases, and essentially an asset, cash decreases. In this case, because we paid for it, and we know anytime we see paid, that means that cash is leaving the business, therefore, cash will be credited. So in this case, we debit miscellaneous expense for the $180, and we credit cash for the $180. Keep in mind, for a company, another company, instead of using miscellaneous expense, they might have an account called advertising expense. So the naming of the expense account changes, but the rules of debit and credit remain the same. We would debit the advertising expense account and credit the cash account for $180. For transaction 6, it states Net Solutions paid creditors. So we set up our liability account, we purchased the equipment on account, and then now we are paying off a portion of the balance that is due. So our liability accounts payable is decreased with a debit for $400, and our cash is decreased. Again, anytime we see paid, we know that cash is going to be credited. Next, we see December 11th, Net Solutions paid their creditors the $400, so we debit accounts payable, credit the cash. On December 13th, Net Solutions paid a receptionist and a part-time assistant $950 for 2 weeks' wages. So we see paid, we know that cash is going to be credited, and in this case, we have wages expense. So one thing that you will see is that anytime we've incurred an expense, the logic remains the same. We will debit the respective expense account, and if we paid for the expense, we would credit the cash account, and if we are going to pay for it later, we would credit a liability account, some form of a payable. Transaction 8, on December 16th, Net Solutions received $3,100 from fees earned for the half of December. So here we had an asset account, cash. It says we received $3,100 for the first half of December. So we would debit our cash account because there's an increase to our cash. And then we would credit our revenue account, which in this case is fees earned or the income that we've earned. For transaction 9, December 16th, fees earned on account totaled $1,750 for the first half of December. So what this simply means is that we provided services to a customer, and they let us know that they're going to pay us later. So therefore, we're not debiting cash because we didn't receive any cash. However, we're using that special account that's set up to track any income that's owed by customers. So therefore, we debit our accounts receivable and we credit our fees earned, our revenue account. So anytime a business agrees that a customer can pay for services provided or products sold at a later date, an account receivable is created. An account receivable is a claim against the customer, and it is an asset account. Next, we have transaction 10. And on December 20th, Net Solutions paid $900 to Executive Supply Company on the $1,800 debt owed from the December 4th transaction. So in this case, we are paying off our liability. And again, we see paid. So we know that cash is going to be credited. So therefore, we debit our accounts payable and we credit the cash account for the decrease to our liability and the decrease to our cash. Transaction 11, on December 21st, Net Solutions received $650 from customers in payment of their accounts. So when customers pay amounts owed for services that they previously received, because keep in mind, the first thing that we did is we set up an accounts receivable. We've already earned the revenue. And initially we debited accounts receivable and we credited our revenue account. So in this case, we are now receiving the cash. So therefore we debit cash because we know there's an increase, and we reduce the balance that the customers owe us by crediting our asset account for the decrease. For transaction 12, Net Solutions paid, and we know anytime we see paid, that means that cash is leaving the business. Therefore, we need to decrease cash with the credit. And in this case, we purchase supplies. So we would debit our asset account for $1,450, and we would credit cash for the $1,450 to show the decrease. So keep in mind that with each transaction that we refer to, we are following the rules of debits and credits. Assets are increased with a debit and decreased with a credit. Our liabilities and stockholders' equity accounts are increased with a credit and decreased with a debit. So for transaction 13 on December 27th, Net Solutions paid the receptionist and the part-time assistant $1,200 for 2 weeks' wages. We debit our wages expense and credit cash. So we saw in a previous example that $950 was paid to the receptionist. The journal entry was exactly the same. The only thing that was different was the amount. In the previous example, $950 was paid. And in this example, $1,200 is being paid. But the journal entry was the same. We debited the expense account and we credited the cash account. Next, we have transaction 14. Net Solutions paid its $310 telephone bill for the month. So in this case, we're dealing with a different expense account, utilities expense. In the previous example, it was wages expense. So we debit the utilities expense for $310, and we know that we see paid, which means that there is a decrease to an asset account, which means that the cash account must be credited. For transaction 15, this is similar to the preceding transaction. In this case, we have the electric bill for the month. In the previous example, we had the telephone bill for $310. And in this example, we have the electric bill. So we debit utilities expense for the $225, and we know that cash is impacted. So we credit our cash account. For some companies, they might choose to break out the expenses. In this example, we're using the same account to track utilities. But for some companies, they will want to have a separate telephone expense and a separate electricity expense. Same logic, you're still debiting an expense account and you're crediting the cash account. For transaction 16, December 31st, Net Solutions received $2,870 from fees earned for the second half of December. Cash is coming in. We have an asset, as mentioned. Cash comes into the business for one of three reasons. You borrowed money, the shareholders made an investment in the form of common stock, or you've earned money. In this case, the business earned money. Transaction 17, the fees earned on account totaled $1,120 for the second half of December. So with this transaction, what essentially happened is we provided services to our customers, we earned the revenue. However, they promised that they are going to pay us at a later date. So therefore, we set up this accounts receivable account to track how much money is owed by customers. December 31st, dividends were paid of $2,000. So we know that dividends represents a decrease to stockholders' equity, and decreases to stockholders' equity are recorded as a debit. So we debit our dividends account and we credit cash, because paid, we know there's a decrease to cash, so therefore we credit our cash account. So this brings us to the general ledger. We've essentially recorded all of the transactions, and then at the end of recording these transactions, we get the general ledger, and it shows us the balances for each account. So this is for our cash account. We see all of the transactions that impact cash, all of the transactions that impact accounts receivable, supplies, prepaid insurance, land, office equipment, accounts payable, unearned rent, common stock, dividends, fees earned, in our various expense accounts. So think of it like if you have a bank account and you have both a checking and a savings account. If you withdraw money from your savings account, it does not have an impact on your checking account, vice versa. If you make a withdrawal from your checking account, it does not have an impact on your savings account. So with that being said, that is the purpose of the ledger. Each account has a specific account that tracks all of the increases and the decreases to that specific account. So now, after we've recorded all of these transactions, we recognize that there might be errors. So errors may occur in posting debits and credits from the journal to the ledger. So one way to detect some of these errors is by preparing what's called a trial balance. So as we pointed out, double entry accounting requires that debits must always equal credits. And the trial balance helps to verify this equality. So the steps to prepare a trial balance are as follows. Step one, we would list the name of the company, the title of the trial balance, and the date that the trial balance is prepared. We would list the accounts from the ledger and enter their debit or credit balance in the debit or credit column of the trial balance. Step three, we would total the debit and credit columns of the trial balance. And step four, we would verify the total of the debit column, and it must equal the total of the credit column. So we have what's called an unadjusted trial balance. And the preparation of the unadjusted trial balance, because again, there might be some things that we eventually need to adjust. So here we essentially have an example of a trial balance for Net Solutions. And we essentially take into account the account balances that were taken from the ledger. So as mentioned, sometimes there might be errors. If the trial balance totals are not equal, then it is more than likely an error has occurred. So in this case, the error must be found and it must be corrected. So a method useful for discovering errors as follows. So in the event that there's what's called a transposition error, so if the difference between the debit and credit column is evenly divisible by 9, then we would trace the account balances back to the ledger to see if there was what's called a transposition error. So this is basically when you incorrectly copy the amount from the ledger. So as we see here, the amount should have been $542. However, as we recorded it, it was $452. We reversed the 4 and the 5, or maybe we reversed the 4 and the 2. So it should be $542. However, it was recorded as 452 or 524. This is an example of a transposition error. And anytime there's a transposition error, a good indicator is that the difference is evenly divisible by 9. The difference between the debit and credit column is evenly divisible by 9. Next, we have what's called a slide error. So with the slide error, this is basically where the entire number is copied incorrectly, or one or more spaces to the right or to the left has happened. So this is essentially, let's say, again, same amount, $542, but instead we moved the decimal point to the left. So instead of 542, we recorded $54.20, or we moved the decimal to the right. And instead of $542, we recorded $5,420. So an error may occur that doesn't necessarily cause the trial balance to be unequal. So it might be that the total debit column and the total credit column tie, but that doesn't mean that the trial balance is correct. So such an error may be discovered when preparing the trial balance, or maybe there might be an unusual account balance. So if an error has already been journalized and posted to the ledger, a correcting journal entry is normally prepared. So an example of this is, let's just say that there's a credit balance in the supplies account. This lets us know that an error has occurred. This is because a business cannot have negative supplies. So once that error is discovered, then there needs to be that correcting journal. So let's say, for example, assume that on May 5th, a $12,500 purchase of office equipment for cash was incorrectly journalized and posted as a debit to supplies and a credit to cash for $12,500. So here we see we purchased office equipment, but we debited another asset account. We debited supplies. And let's say that at the end of the month, we recognize the error on May 31st. So before we make the correcting journal entry, the journal entry that was made in error is compared to the entry that we should have made. So once we compare the two journal entries, the correcting journal entry is then determined. So here we see the entry that was made in error. Again, we spent $12,500 for office equipment, not for supplies, but we made an error. So we debited supplies for $12,500, which is an asset account showing the increase, and we credit the cash account for $12,500 to show the decrease in our cash account. But the correct entry should be a debit to office equipment and a credit to cash. So we see that cash is correctly credited for $12,500. There's nothing that needs to be done. However, we see that we should have been debiting the office equipment as opposed to supplies. So in order for us to fix this journal entry, we would remove the $12,500 from supplies by crediting the supplies account for the full amount of $12,500, and we would debit the office equipment account for the $12,500, and that would be our correcting journal entry. All right, so here we have an analysis for decision making. And this is objective 5, and this is essentially us describing and illustrating the use of a horizontal analysis in evaluating a company's performance and financial condition. So in a horizontal analysis, the amount of each item on a current financial statement is compared with the same item from an earlier statement or period. So a single item in a financial statement, let's just say such as net income, it's often useful in interpreting the financial performance of a company. So a comparison with prior periods often makes the financial information even more useful. So we compare net income of the current period with the net income of the prior period, and that will essentially indicate whether the company's operating performance has improved or maybe it has declined. So in the horizontal analysis, the amount of each item on the current financial statement is compared with the same item from an earlier statement. The increase or decrease in the amount of the item is computed together with the percent of increase or decrease. And when two statements are being compared, the earlier statement is used as the base for computing the amount and the percentage of change. So here we have an example to illustrate the horizontal analysis of two statements for J. Holmes, attorney at law. Here we see. So in 2007, our fees earned was 187,500. And for 2006, it was $150,000. So here we see that there's a difference of $37,500. So essentially, we see that there was a change between year 6 and year 7. And we were able to calculate the difference between the two, which is $37,500. In order for us to determine the difference between the two, our calculation would be as follows. We see the difference, which is the $37,500, and we do 37,500, and we would divide it by the base amount, which represents the fees earned in 2006. And that is how we determine the percentage of 25. So 37,500 gives us the 25%, in this case, increase. The same thing applies to our wages expense. 2006, the wages expense was 45,000, and in 2007, it was 60,000. So if we see the difference, which is 15,000, and we divide it by the base amount from 2006, we see that it is a 33.3%. So with this example, it just shows how a horizontal analysis, it can be useful in order to interpret and analyze the income statement. The horizontal analysis, it can also be performed for the balance sheet, the statement of stockholders' equity, as well as the statement of cash flow. So this brings us to the end of chapter 2, analyzing transactions. Now that the lesson is ended, we should have learned how to describe the characteristics of an account and chart of accounts, describe and illustrate journalizing transactions using the double accounting system, describe and illustrate the journalizing and posting of transactions to accounts, preparing an unadjusted trial balance and explaining how it can be used to discover errors, and describe and illustrate the use of horizontal analysis in evaluating a company's performance and financial condition.